Hello, everyone. Good evening. Warm welcome to this Your Market Navigator Expert series. I welcome everyone on behalf of Aditya Birla Sun Life Mutual Fund. Today, we have a session with Mr. Atul Penkar, who's our Senior Fund Manager. Before getting into Atul Penkar, so let me uh, describe what we are going to look at, which fund we are going to focus today. So we are in testing times, no doubt about it. One side we have war, another side we have the liquidity going away from the market. So if that happens, we will know the effects of what will happen. So over the last 2 years, we've seen a lot of easy money, which is sloshing around the market and taking the market higher and higher. But over the next couple of years, we might see a lot of struggling for money to come back. Then how the markets are going to behave. Uh, we we uh, uh, we are really confident that the markets will turn back to normalcy at the earliest. But given the kind of scenario, we would like to analyze the fund, which is also going through turbulent times over the last 2 3 year period. So, which is ABSL Aditya Birla Sun Life Tax Relief '96. This fund has a track record of about 26 years. The track record is nothing but staggering if you look at it from the outside. But if you look at the last 2 3 years journey, the fund has severely underperformed the benchmark as well as the peer group. So to describe about that, we have Atul Penkar today. So again, Atul Penkar is coming in to manage this particular fund since Jan 2022. There is a change of guard. Ajay Garg, who was earlier managing this fund for a long period of time, which is close to about 16, 17 years, has moved on, and now Atul Penkar is now taking over the fund. So Atul is also taking over this particular fund at a testing time at this point. I think it's going to bring the best out of Atul going ahead. So let me describe what Atul has been doing over the years. So Atul comes with an experience of about 20 years plus, and he's been part of Aditya Birla Sun Life Asset Management Company. All these while managing different roles and responsibilities. Since August 2011, he has moved on to manage our international businesses, which is India dedicated offshore funds. And the funds which he was managing was India Frontline Equity Fund and India Quality Advantage Fund, and Sun Life Excel India Fund and India Advantage Offshore Fund. Besides that, Atul also provides investment advisory to dedicated equity mandates for sovereign wealth funds and pension funds. With effect from Jan 2022, he's been entrusted with the responsibilities of ABSL Tax Relief '96 and tax plan as well. So along with Bal Bhavishya Yojana. So Atul has been with Aditya Birla AMC since April 2006. So that is again close to about 16 years of experience in the same organization, where he started as a senior analyst and grown in stature. Prior to moving into international investments, Atul was responsible for managing multiple offshore, thematic, and diversified equity strategies in India. So his equity research expertise in Indian market is across information technology, infrastructure, telecom, auto, and media. So which are the sectors which are expected to do really well over the next 4 5 years period. And prior to joining Aditya Birla AMC, he has worked as an equity analyst at various reputable organizations, namely MK Global Financial Services as a senior analyst. So Atul holds a bachelor degree in engineering and masters in management studies as well. So I extend a warm welcome to Atul Penkar to this session. Yeah. Thanks Atul for joining us today in this Your Market Navigator Expert Series call. And it is going to be a enriching session for all our partners who have joined us, taking their time out. So I welcome them once again and thank them. Being over the years. And this fund, if we have the growth now from the fund, I think that would be the best now in the entire industry across. But unfortunately, we don't have the growth now in this particular fund from the inception. So we have introduced growth now somewhere in 2008, 2009 period. So hence the growth now is actually lower. So as per the calculation, internal calculations currently, had the growth now been there, so the fund would have multiplied money 200x from the inception. So that's the kind of track record this particular fund has gone through. So that's the background about the fund as well. You must be knowing about it, but for all our viewers today, so I just want to explain the particular part so that I can put perspective for all of us. Uh, Atul, would like to understand better from you that if you can able to explain or elaborate about your own style or how you approaches investments.
Right, sure. Thank you, Swami. So if you look at my investment philosophy or investment style, it's basically looking at growth at a reasonable price. That's the underlying philosophy. Why growth at a reasonable price is because predominantly India is a growth market. And not only it's a growth market, but it is also an emerging market. And, being high growth market and a part of emerging markets, given the kind of dynamics that we have, it's also somewhat volatile in nature. And therefore, with that context, I think it's better to have, a combination of growth as well as some bias towards valuations. Because when you buy growth stocks and at a reasonable valuation, that gives you some kind of margin of safety when the market becomes volatile. Therefore, in that context, I think growth at a reasonable price pays off well. And if you look at from Indian market perspective, whether it's last 5 years, 10 years, 15 years, growth has been handsomely rewarded by markets. I mean, there are periods where value does work, but those are certain pockets where value does work. And in that context, I think being growth orientation helps in kind of capturing the upsides in the market and buying companies or businesses at reasonable valuations reduces the underlying volatility in the fund performance.
Okay, that's good about your basic philosophy about managing the funds. But you've been managing our India dedicated funds, which is predominantly coming from offshore investors. But how do you look at the markets over the last 4 years? It was not a normal market. I think a fund manager with any style of management, it can be growth, it can be GARP model, it can be a value model. So do you think that the styles have worked out in the last 3-4 years?
If you look at last 5 years in particular, right? I mean, till about 2017, everything was going fine. And you had sporadic incidents like 2013, where market was very volatile, and again 2018 and 19. These 2 years were extremely painful for markets because market was actually moving in a very narrow band, and what I mean by a narrow band is you had a handful of stocks which are index heavyweights, the top 5 or top 10 stocks which were performing. And holding on the indices, but the broader markets were quite weak, and that was a typical characteristics of 18 and 19. And just then, during that period, if you look at what has been happening in the Indian economy, growth has been tapering off, and also from certain reforms which were initiated from 2016 onwards, we had seen that those reforms had some short-term implications, negative implication on growth, and hurt Indian economy. 2020, when Indian economy was just about to look up, we had COVID in March 2020, and again market corrected quite sharply during that period. And bounced back equally sharply as all central bankers around the globe induced significant amount of liquidity and reduced rates, and that really helped stabilize the market. And from India point of view, also we've seen that we had the RBI infuse liquidity, Although from government standpoint, we refrained from giving out dole-outs, and which helped in kind of checking the inflation rising up sharply as compared to say 2010 to 2013 period, where there was significant loose monetary policy as well as dole-outs of revenue expenditure, which pushed the inflation past 10%. So in this period, we had growth been pushed higher, and we saw the because of COVID and subsequent control on COVID cases, economy bounced back quite sharply. So I think these are typical characteristics of markets where you have certain phases where a particular section of the market does well, and then 2016-17 was a period where the broader markets, which is small and mid cap, significantly outperformed the large caps. 18-19 was a period where large caps did extremely well as compared to small and mid caps. And again to 2020 and 2021 in particular, we saw that the broader market came back very, very strongly. So I think markets will have its ups and downs, and therefore from a portfolio standpoint, it is very, very important to have a balanced approach towards portfolio construction.
Yeah, good to hear that, Atul. So, given the background, so on the hindsight, we got to know that the markets have behaved irrationally over the last 3-4 years, and we've had reasons for it. So, 2018 we had credit crisis, and 2020 we had COVID. Now we have different sort of crises on our hands, so which is why, coupled with that, we'll have other sorts of problems which might crop up because of this war, which is inflation. And if inflation is going to go up, supply chain is going to get crippled. We might have interest rates going up as well. So anyway, that was about to happen. So how do you foresee the market over the next 2-3 year period? What's your view on the markets?
I think, looking at the current geopolitical tensions and the war, it is extremely difficult to predict, how the events will unfold in the near term, maybe 3 months or 6 months. But if you look at what's really transpiring is because of this geopolitical tension, we have seen sharp rise in commodity prices, and particularly crude oil. And India gets impacted materially because 70% of our requirement is imported, and therefore we actually import inflation into our country because of our huge dependence on crude imports. So from that point, and just to share some ballpark thumb rule numbers, every $10 increase in crude has about 40 basis point impact on current account deficit and inflation, and about 10 basis point impact on growth. So if you factor in that, then obviously one also has to look at that the current prices are spot prices, right? And if you assume that the current spot prices persist for a year, then on an annualized basis, we are talking about that kind of rise in current account deficit or rise in inflation and a lower growth. But as I said, it's difficult to predict how the events will unfold in the near term. I'm sure this situation will definitely go through, and from medium to long term, we remain constructive on the market. But having said that, the near-term challenges persist because of the geopolitical situations.
Yeah. Let's pray that all these temporary problems are transitionary and it passes away, so that we can able to have a stable market. So let's move into the fund as well. The fund what we have today is Relief ‘96, which has been entrusted to you with an AUM of about 14,500 crore approximately. And this fund has actually been adjusted best funds 3 times across Asia. So this fund has its own periods of real outperformance, and it could able to top the chart. But having said that, the kind of underperformance the fund has delivered over the last 3 years, so that's been the voice from majority of our partners across India, length and breadth. So I have few set of questions which has come from them only, so which we have collated from all of them. So the mindset or maybe the mood amongst all those partners who have supported us wholeheartedly in this particular fund is bit down today. So what would you like to tell them? So how do you address them today so that they take your confidence going forward and they can able to look back at this particular fund and start supporting us?
Uh, yeah, I think it's a very interesting and valid concern that most of the investors have, and as you rightly said, I have taken charge of this fund in Jan 2022. The first thing I kind of deep dived into the portfolio and tried to understand the genesis behind what transpired and led to the way the portfolio has behaved in the last 12 to 18 months in particular, right? So, and even beyond that. So, as I said, if you look at our portfolio, 96 portfolio, and look at different time periods, right? So, till about 2017 or 18, the portfolio was doing quite well. And then came, the financial crisis and a phase where we saw that the broad narrow markets were doing very, very well. So it was the top 5 or top 10 stocks doing well. And the portfolio was positioned almost 50% of its weight in small and mid cap stocks, right? So because of that, the very nature of the positioning, it kind of underperformed during that period. And when COVID started in 2020, and market began to correct sharply, that was a brief period of time where because of the way the portfolio was constructed and biased towards high quality companies, for a brief period of time the portfolio actually did well. And thereafter, when the market rally began, driven by initially liquidity from FIS, domestic mutual funds, and retail investors, we saw market rallying quite sharply. And in that rally, the portfolio suffered because of the bias towards high quality. And therefore, when you look at this last 3-4 years and last 12 to 18 months in particular, the portfolio has suffered because of bias towards high quality companies, which has not participated in the rally, and somewhat corrected in the concern because the high PE stocks were correcting beginning December and January. So, these are the two phases where the portfolio kind of got impacted. But that's the real view, what really happened in the past. But I think what is more important to understand is, and let me share with you, my thought process on how I look at things, how do I look at Indian markets and the outlook going forward. So if you look at from 3-year or 5-year perspective, we are currently about $3.5 trillion economy. Over the next 5 years, we will be touching about anywhere between $5 trillion to $6 trillion in economy in size. And with that kind of size, we will be one of the largest market in terms of market cap. It also means that our GDP per capita will double from current levels. And whenever that happens, we've seen that there is significant amount of consumption boom which happen. So if you look at from current level to say next 5 years and try to draw that path and kind of do a macro analysis on how the economy will shape up, which segments of the market or which sectors will be leading that or will be benefiting from that GDP expansion. On that basis, I believe that consumption will be a key beneficiary of that, besides industrials and financial. So these are the 3 sectors which I believe will benefit because of the kind of transformation we are looking at from economic standpoint. And over the medium to long term, we'd like to position the portfolio in that, because consumer discretionary as a sector, there are very good quality companies, high growth companies, and incidentally, what is happening now is because of the risk off sentiment, most of the companies are correcting. and which is actually giving an opportunity for us to buy into those names that we don't own. But having said that, we are not in a hurry to kind of jump in and buy those companies. We are adopting a more gradual approach towards portfolio realignment, given the fact that we also have very good quality companies. So we are taking our time to kind of rebalance our portfolio. But the thought process is over the next 3-5 years, align the portfolio in line with the sectors which will be benefiting the most from the GDP transformation that we look at. So that is one. Second point is when you look at from market cap to GDP ratio, currently we are about 1.1 times. Even if we maintain that our market cap to GDP remains at 1.1 times, and looking at $5-6 trillion economy over the next 5-6 years, the market itself will provide you that kind of significant returns from over the next 5 to 6 years. Besides, the structure of Indian market is transforming. And I'm sure everybody has experienced that over the last 12 to 18 months with, many private companies getting listed, profitable companies getting listed, not so profitable or loss-making companies getting listed, or the so-called new age technology companies getting listed. So you need to really scrutinize those companies and this is where the GARP investment philosophy comes handy. That you apply that philosophy in evaluating those companies and taking a very informed decision on investing into those companies. So it's an interesting time from a medium to long-term perspective. But the short-term pain that we are going through actually provides a good opportunity to realign and rebalance the portfolio.
Sure. Thanks, Atul. I think you mentioned about the sectors which you will be focusing on. But if we can able to dwell into the portfolio, I think I understand that the portfolio is transitioning from a quality conscious fund manager to a GARP style fund manager. So the portfolio has to make quite a transformation from here on. But given the kind of backdrop what we have in the markets, so do you think this transmission or maybe the transition is is going to be very smooth from here on? Because the kind of sectors which I see at this point in time, so we have an overweight position in pharma, so which is corrected quite sharply in the last year or so after a good run during the COVID period. So I think we have made money and we've also lost money in this particular sector. So the overweight is not just about 2-3% higher; it is actually 10% vis-a-vis the index if you look at it. And similarly, cement and construction as well. I think these are the themes which are looked up, which are being looking up. But how do you see these overweight and underweight? I think we are completely underweight in metals and IT. If you look at given the kind of benchmark numbers which we have, so how do you transition this particular anomaly? Because portfolio is quite unsettled at this particular point in time. That's what we see in the fact sheet we see.
Yeah, I think your observation is right, but let me address your first point regarding the positioning from quality perspective and GARP perspective. I think there is slightly. It doesn't mean that that adopting a GARP philosophy changes the quality bias. So GARP as an investment philosophy is more about applying a framework for evaluating companies, and that framework we will use and invest into quality companies, right? So there is no, it is non-negotiable kind of approach where we won't dilute our focus on quality. So the quality focus will always be there. It's just that we will have more. We'll implement the GARP framework when we look at evaluating and investing into the companies. So that is the first point I wanted to make.
No, let me just intervene here. So what I meant quality is that quality at any price. You said quality at a reasonable price. So there is a difference between the pricing point, right? So that is what people understood from our earlier discussions, that we would like to stick to quality at any price, because most of the stocks which are there in the portfolio, I don't want to name the stocks, but are of MNC in nature to a larger extent. So they are available at the higher PE multiple at this particular point in time. So it clearly shows that price at any point. quality at any point, any price.
Right. So yeah. So your observation is correct. And so there is a bit of a difference here that between quality at any price versus quality at reasonable or slightly higher. But by its own definition, quality comes at a price, and
Right.
the framework that I will be looking at is what is the absolute upside which is available in stocks. Okay. So when we are evaluating, so firstly is in terms of the approach, when we are looking at investing into companies or evaluating companies, the approach is basically to look at what is the business model, how scalable is the business model, what's the kind of mode the business model has, what is the quality of management that it has, what is the track record of the company, what is the kind of cash flow, what is the balance sheet strength. So all that thing is a hygiene factor. Okay, so that goes without saying. What I'm trying to insist is when you evaluate and invest into companies, my approach is more that when I'm looking at investing in this company over the next 3 years or 5 year period, what is the absolute upside the stock offers me, and then look at relative to the market or relative to its peers in that particular sector, and that again using the same framework as such. So that brings that the growth angle into constructing the portfolio. That brings the quality angle also into constructing the portfolio. So that's the first point. The second question that you had was in terms of the portfolio positioning. Yes, the healthcare sector is a significant overweight, and some of the sectors where we have the portfolio was underweight was IT, which kind of did remarkably well in 2020 as well as 2021, and that's the reason why the portfolio also suffered during that period. So kind of looking into that, and you would have noticed in the last couple of months' time there is some visible change in the sector allocation that. Not in a major manner, but a more calibrated approach. You would notice that there is certain shift in sectoral. So, for example, if you look at the current context, right? I think and kind of look at the next 3 year or 5 year period that we're looking at. In the current context, because of the sharp correction in the market, we are actually getting some of the large banks at much reasonable valuation, right? And if you look at our portfolio positioning, we have been underweight in banks as well. So
yes.
So that is the segment that we have kind of on a gross basis. In the last 2 months, we have increased our weight by almost 4% or 400 basis point in banking alone or financials alone, and predominantly that is in banking. And in terms of thought process, the view is very clear that the larger banks will stand to benefit the most over next 3 to 5 years, because the NPA issue is behind them. They have very strong balance sheet. Also in terms of growth, these are the ones who will lead the growth. And the valuations are attractive at this point of time. So, with that approach, and even when you talk about IT sector, you would have noticed that, in the month of Jan, when technology stocks actually started correcting, that was the time we actually increased our exposure in IT, again, in a very calibrated manner. So, and that you could see from portfolio changes in the last couple of months. So the point is, there is certain method and target. It's more calibrated approach, and to kind of maximize the opportunities, right? Because if you look at the current portfolio, the stocks have underperformed, and investors have suffered because of that. And I'm mindful of that. And the same stocks which have significantly underperformed in this market in the last couple of months have kind of relatively done well. But there is some bounce which is imminent because the way the stocks have corrected, and therefore it's better to kind of wait and utilize the bounce and kind of realign. Okay, so I don't want to, the investors, because they have taken the pain in the last 12, 18 months, and also suffer when the stocks bounce by selling those stocks at lower levels. So that's a kind of approach that I have.
Yeah. So thanks a lot, Atul. So I think you made it very, very clear that you are making these changes at the portfolio level. And if banks are moved up by about, especially financials have moved up by about 4% in the last couple of months, I think we still quite a gap to cover. So at the index level, banking and financials are holding up to what 33, 35% kind of an weight, but we still have about 23% weight in our portfolio. So I think quite a big gap to cover from here on. Okay.
So as we speak, it's
When we
about
are talking,
26.5%.
so I would like to just touch upon the sectoral weight and top 10 stocks as well. So if you look at the top 5 sectors, which are amounting to about 53% of the portfolio, and top 10 stocks is close to about 58-60%. So that's quite a concentration and top heavy fund to see at this particular point in time. And market corrects, obviously corrects a lot as well. So how do you see to address this particular issue, or is it fine with you to manage it in such a level only?
I mean, there are advantages and disadvantages of having a concentrated portfolio. Right. If you have concentrated portfolios and if you have the right kind of stocks, it's highly rewarding, right? And we've seen that this particular portfolio, I mean, the structure of the portfolio has remained the same, and in the past has delivered far superior returns. But also, disadvantages, it has suffered also, right, in the last couple of years. So there are advantages and disadvantages of having a highly concentrated portfolio. I think, from portfolio construction point of view, I think it's 45 to 55 stocks will be an ideal situation, because 45 stocks give you that necessary concentration benefit. And depending on the market situation, how broader markets are doing, if you have, say, slightly higher number of, that gives you extra leeway to accommodate some of the opportunities that you see are available in the market space. So I think that is a band I would look at, from portfolio construction point of view. But obviously, it all depends on how the market shapes up.
Okay. Thank you. Atul, my next question is that, yeah, we've spoken about how the portfolio is going to transition, what kind of sectors we're looking at. But if you look at the pure number in terms of performance over the last 1 year, 3 year, and 5 year, so the portfolio has underperformed the peer average by a quite significant margin. And currently, the portfolio is there in the bottom of the fourth quartile. So by making all these changes at the portfolio level, how do you see that the portfolio will catch up and start moving in quartile performances? I'm not asking you to put a number to it, but in terms of quartile performances, where do you see yourself maybe a year down the line or two? So that gives a lot of confidence to the advisors who are part of are selling this particular product, who sold this particular product.
Right. I think it's a very, very, very important question. And, I have looked at, obviously, our portfolio positioning, looked at, how the portfolio is positioned versus competition. So there is a clear heat map, which I have, demonstrating sector-wise, stock-wise, our positioning versus the competition. And kind of identified what are the gaps that that needs to be filled in, where we are lacking in terms of the catch up that we need to do over the next a couple of years. I think the gap is huge, but there is I mean, if given the kind of approach that I'm talking about, I mean, there's no reason why over the next 1 year or 2 year, we can't be in quartile 1 or quartile 2. I mean, there's no reason for me to believe that with the kind of changes that we are looking at and realigning the portfolio, which will be in quartile 1, quartile 2 over the next 1 to 2 years period.
Sure. There is a pertinent question which is coming in from the viewers as well as from the advisors as well in the market, that how rigid you will be in your approach going forward. So you have built a portfolio. So how long you will see that portfolio to underperform? Outperformance is fine with investors and distributors. But if a particular model is not working and if it is going to underperform for a prolonged period, how rigid you will be?
I think
when you make the changes.
Yeah, I think the key to success is to because over the last 2 decades or so that I've been tracking markets, started as an research analyst, covered various sectors. I think what that experience has molded my thought process is one has to really adapt to changes, and rigidity is something which actually doesn't work in favor of the portfolio and its investors. And one really have to keep his eyes open to kind of see through what are the opportunities available in the marketplace. And it's across, right? It's across the spectrum, whether it is any particular sector or across market cap, whether it's large cap or mid cap or small cap. If a particular stock is offering 40% or 50% upside, obviously it needs to fit into our framework of GARP as well as meet those quality requirement that we spoke about. There's no reason why not to invest in that company, because that is the opportunity which is available. And again, if it is fitting into the 3-year and 5-year horizon, I think one should be looking at. And let me give an example without talking about a name. If you look at the consumption pattern in India, and I think that has undergone significant changes in the last, I would say, 5 years or so. So out of home consumption has gone up materially. There is a lot of growth opportunity because that segment of the market is highly unorganized, and there are a handful of organized players in that market. And we are seeing a significant amount of growth, not only because of expansion of network, because network expansion will give you, say, every year if the network is expanding by about 10 to 12%. The network expansion itself will give you that kind of growth. Plus, the increase in consumption pattern will add to that. So initially, you can, the next 3-5 years, you can easily look at, say, 15 to 20% kind of growth in that segment. And if the valuations are at, comfortable level, with that kind of 20% earnings growth available for next 5 years, there's no reason why one should not be investing in that company. So having said that, it's more about flexibility to adapt to changing market situation, have an open mind towards looking at various sectors, have an open mind towards looking at whether the business that we own is gaining market share or losing market share. And if that is the case, one really has to deep dive into the reasons behind those and take appropriate actions.
Sure. Thanks, Atul. So, given the kind of changes you are making, so maybe a couple of quarters down the line, what kind of exposures this particular fund will have in different caps? So, after the market correction now recently, so looks like the valuations are slightly reasonable across caps, while still mid and small caps are slightly trading at a higher valuation compared to the large caps. But given the kind of scenario, so how do you like to see this particular portfolio panning out?
I will refrain from putting what percentage of portfolio will be large cap or mid cap or small cap. I know it is more about bottom-up approach. And let me again,
Why I ask this question, maybe let me just reframe it. Because given the kind of nature of the fund, because whatever money comes in gets locked in for 3 years. So it doesn't go out that easily. So from a distributor and investor standpoint, he's giving us the money in this particular fund for a longer term period. So then ideally for them, if it can able to give them an aggressive stance to make extra return from a market perspective, I think they're okay with it. That is what this particular category has been offering for a long period of time. So hence this question.
Yes, so I appreciate that. And in that context only, I just wanted to share my thought process on how I construct my portfolio. So fundamentally, when I'm looking at constructing the portfolio, it's more about a combination of top-down as well as bottom-up analysis. So basically, top-down is towards looking at sectors where when we look at and do the macro analysis and look at how things will shape up from the next 3-year or 5-year perspective, look at which are the sectors which will benefit and do well over next 3 to 5 years, and therefore that kind of macro analysis helps us in taking that 3-year call on which sectors we need to be overweight. Now that is a top-down call. And then comes the bottom-up call. Once the top-down call is taken, that which are the sectors, then we look at bottom-up approach towards which are the stocks or which are the businesses that we need to own basis our analysis of those companies. And this is how we actually marry our top-down approach towards sector allocation and bottom-up approach towards stock selection. But also let me highlight here, one very important aspect that it is very important. There are two focus areas for me as a portfolio manager. One is generate alpha on consistent basis, and the second and equally most important parameter is risk management. And therefore, it's very important to look at both these factors in hand. And the idea is to deliver consistent risk-adjusted returns over a full market cycle, and not really have the fund performance move in a very sporadic manner in a particular period of time. So I think that is the thought process, and all the actions that I take in my portfolio is towards how do I generate an alpha, and and also be aware of what is the underlying risk I'm taking in the portfolio to be able to generate that alpha, and being aware of the risk helps, because when things doesn't really pan out the way one is expecting it to be, that awareness does help in kind of adapting to the changing market situation.
Got it. Thanks. Atul, currently we don't have limits to expose the portfolio for overseas stocks. But if in case it opens up, do you foresee that this particular fund will also invest in overseas stocks to bring in that kind of a diversification?
I think overseas investing in overseas stocks does give some kind of diversification, and I'm open to that, depending on the ideas which are available. But at the current context, my hands are full in terms of I see a lot of opportunities available in the Indian market space itself, but I'm open towards investing in overseas stock if the opportunity comes our way.
Okay. Other than that, you will also be interested in playing out any of the special themes which are coming up, like special situations which emerges in the market. You would like to take catch hold of that particular situation and play out in this particular fund?
Why not? If the risk reward ratio is favorable, and if it is a fundamental driven call from which fits our investment strategy, I'm open towards taking that call as well.
Okay. And what kind of cash levels you will be happy to maintain at all points in time in a portfolio? Because I do understand that cash is not a comfortable thing for a fund manager to manage. But still, what kind of cash levels you will be comfortable in managing this particular fund?
Yeah, under normal conditions, okay. Under normal conditions, I would be okay with about 1 to 2% cash in the portfolio. But at times the cash levels might go up with an intention that or expectation that the opportunity might open up, and therefore one needs to have that cash handy to take that opportunity. So with that thought process, there could be instances where the cash might go up, but on normal basis, 1 to 2% cash, not more than that, we'll be having in our portfolio.
Okay, times like these, I think if you have cash in hand, probably it will become handy for you to invest, deploy that. What kind of cash levels do you have in this particular fund?
I would have loved to had 8% or 10% cash in the portfolio, because this market opportunity which is now available, I would have been happy to kind of deploy that kind of cash, because these are the times where and I've been talking to, for the last, before I took up this, I've been an investment advisor for my overseas investors, the institutional family offices, so the best time to invest in India and make money is when the markets are down and nobody's looking at Indian markets. When everybody is kind of on the sell mode, I think that is the time, because it actually it gives a dual benefit. One is the market gives you good opportunity because the long-term growth prospects of the market is good, and secondly, during these times, typically the currency also is depreciated, right? So for overseas investors, that is the best time, because the markets are down, the currency has already depreciated, and therefore if market moves up and currency is somewhat appreciate, that gives you an additional bump up to your returns. But from domestic investors' perspective, I think these are the times that one needs to really look at considering maintaining their SIPs or investments into markets. Given that these are the times where actually give you opportunity to invest and benefit from long term. But obviously, one needs to have that 3 to 5 year horizon. And I'm not saying one needs to go full hedge and then deploy the entire allocation in one go, but pace it out. I think that's the better option.
So there is a pertinent question which is coming from the viewers, that how long you will typically take to reconstruct the portfolio? Maybe the entire portfolio will look like settled in your view. Maybe given the kind of situations what we have currently.
No. So we are not looking at changing the entire portfolio. It's
no. I'm saying not entire portfolio. The question which is asked by a particular viewer is that how long you will take to make the portfolio settled?
I think
standpoint.
Yeah, I think looking at the current market situation and the current positioning, okay, that is there. It will take anywhere between 6 to 12 months for us to realign the portfolio. Like I said, I don't want to rob the investors of the potential upside on these beaten known stocks that we already own in the portfolio, because they have taken the pain in 2020 and 2021, and 2022. If there is a bounce in those names, I don't want to kind of be in a hurry to sell that and realign the portfolio just for the sake of it. So it's a more informed decision that I'm taking. It's more gradual approach that I'm taking in the portfolio.
Okay. So given the kind of elevated levels the oil is trading, so is there any direct impact to the portfolio from the current level? Because we are exposed to oil and gas as well. But can we take more exposure there? Because there is one question which is very, very pertinent on that particular thing. So are we taking advantage of that particular sector?
See, if it's an oil exploration company, right, then that company stands to gain because of higher oil prices. But if you are a refining or a marketing company, then actually it's not really. You could benefit from refining margins going up, But the biggest beneficiary is the oil exploration companies, and unfortunately in India, we don't have too many oil exploration company, and that's the reason why we import a significant amount of our oil requirement, right? So that will be a practical constraint for us from actually benefiting from that oil. But to answer that, how does it impact really higher oil prices? So I spoke about the positive impact, but if oil price were to remain at around $130 or maybe higher, then that's the direct impact is by way of the crude and crude related derivative products prices going up, which is an input for a lot of consumer companies. So the raw material prices goes up, and therefore their margins could get impacted unless they decide to increase prices and pass on that increased prices to the consumers. Obviously, it's a gradual process. Every company doesn't really take the full price impact, a price hike in one go, because it does impact the demand, and therefore it's a more gradual. So the first order impact is in terms of higher raw material cost impacting margin. The second order is also it's more inflationary in nature, and given the way things are, and particularly from Indian standpoint, inflation has been slightly at the higher end of RBI's tolerance level. And if fuel prices move up, commodity prices move up, inflation, it could have the inflation going up. And therefore, the accommodative stance which RBI has been adopting in the last 12 to 18 months, there will be some kind of tightening, there could be some kind of rate increases which will happen, and that's a second order impact besides the government finances, right? Because crude at $130 will kind of strain the current account deficit, and therefore that dollar has been allocated towards it, and that will constrain government's own spending on infrastructure. So it's kind of a cascading impact that we will see if oil remains at elevated levels for long.
Okay. There is one more question from our viewer, is that are we looking at taking exposures into PSU stocks as well in this particular portfolio? Because PSU stocks have been quite corrected well in this particular drawdown, but they are attractively placed as well.
So where there is a strong moat in that company, PSU company, we'll be happy to take exposures. So it's not a strict no for me. And you would have seen that I don't want to name that, but we have taken exposure in our portfolio in the banking space using the correction. So I'm not close to any. I don't have that a strict no for PSU company.
Okay. And there are a few other questions which are asking about do we play if infra does well over the next 3-4 years, should we take a significant position in that, maybe infra related sectors? So currently we are under owning metals, for example. So do we have any plans to take advantage of that particular sector?
Yes, because we had zero exposure, and we did take some minor exposure, but the way stock prices just moved up in a very short period of time, we didn't get the opportunity to build up in that space. It's more of a tactical call, but that's the thought process, that if there is tactical calls, I'll be happy to take that calls. But from more structural point of view, the sectors which I mentioned, those are the sectors which includes the industrials or the infrastructure sector. And industrials is a more a broader term which I'm using here, because it includes your capital goods, it includes your EPC companies, it includes your engineering goods companies. So industrials overall as a sector in our portfolio is something that I'm looking at for being overweight from next 3-5 years perspective.
Sure. Atul, currently the fund's beta is about 0.8685. So where do you see the beta to be? Because if this were to be a slightly high beta fund, so then the fund tend to do well, and it shows its aggressive side as well. Being a long-term fund for most of the investors who come in, because they've made up their mind to lock in their money. So it is naturally to be a high beta fund, right?
Swami, I have a difference of view here that, beta of the underlying portfolio is not by design. It's more about, what you own in the portfolio, right? So I don't have a target beta in mind. What I have is a target businesses which I want to own in the company in my portfolio. So I know I'll rather focus on identifying good businesses and investing in those companies. And beta is an outcome of what I will be owning in my portfolio.
Okay, thank you. Thanks a lot, Atul. I think we are at the close of this particular session. So I just leave 1 minute to you. If you wanted to address people in terms of calming their nerves and giving them confidence about the portfolio. So it's up to you.
Yeah, sure, Swami. So I think thank you all the participants for dialing in this call. And it had been a painful period for the last couple of years that markets have been rallying so hard, and the portfolio has now been lagging behind. So thank you for the patience, and I'm sure the strategy that we are looking at in realigning the portfolio will pay off over the next 1 to 2 years period. And I'd like to thank you again for being invested, and thank you for attending this call.
Thanks a lot, Atul. I think we will do well over the next coming years, so that it gives all the more comfort to all the investors and distributors who have entrusted their money with us. We will do well. So there is always a dawn after a dark of 12 hours. So we really hope that after 2-3 years of painful period, we will see a good cycle of 4, 5, 6 years in the coming years. So thanks a lot, all viewers. Let's meet in the next Navigator series. Till such time, stay safe. Thanks a lot. Good evening.
Thank you.